So obviously Nvidia reports earnings today after hours. So what I did for you guys is I took 10 key areas of their earnings call that you want to be mindful of. So I broke it down to bullet points, and I even separated it for like bullish and bearish things to look for. So I'm going to basically give you guys the main things to watch for, why it's important, what to look for if you're a bull, what to look for if you're a bear, or at least bearish things and bullish things. So the very first thing, and the most important, at least in my opinion, is going to be their data center revenue. So this is like Nvidia's crown jewel. It's the most important thing to them, at least in my opinion, right now, which is obviously going to be driven by AI and GPU related sales. Their H100 and their A100. If you're more of a bull, you're going to look for the continued year-over-year growth. So this is going to be a very high growth-driven name, obviously, and because AI is so important, this is our canary in the coal mine, right? This is going to give us an idea of what the future is looking like, or what the future market is going to be looking like. So you're going to want to probably look for over, at least in my opinion, 50% growth in this segment. With that growth, so if we see over 50%, is more than likely going to show enterprise and hyperscaling demand is moving up. People are aggressively looking to grow their AI business, right? And that's going to show more fuel for longer term AI infrastructure spending. Now, with that being said, let me rewind a little bit and say a little preface on Nvidia earnings. I think there's a very low probability that Nvidia misses their earnings. I think there's a very low probability of that happening. However, I think the expectations as they've been are set very high, and that in itself can lead for a very treacherous report either which way. They could blow earnings out of the water, but if these certain things aren't what they should be in terms of like for example, data center revenue might be 30% growth year over year, might be fantastic, but because it's not 50%, because it's not good enough, you could see a little bit of a failure in Nvidia. So just keep that in mind as I'm saying everything. Now, the bearish signal for this data center revenue report would be any slowing down or flattening. So that could suggest a pause in hyperscaling. And you want to keep an eye on like these larger companies like Meta, Amazon, and Microsoft. Now, with that being said, we've seen larger capital commitments from these tech giants. We've seen Meta, whatever it was, 60 to 70 billion of 2025 capex. Microsoft was 80 billion, and X, if you're watching on X, they're looking at 30 to 40 billion. So we see a lot of money going into the segment, but it's how much, and how much is that growth? So that's your very first bullet point to keep an eye on with Nvidia. Now the second, and I'm ordered these primarily in importance, so that kind of helps you guys out too, is your gross margin. So especially you want to look at your data center versus your gaming. So this matters because that margin is going to tell you how profitable each one of these segments actually is. Nvidia's gross margins have been mostly elevated due to the H100s. So if you're a bull, basically kept it like this. Use 75%, for example. So we want to see, if you're a bull, margins expanding over 75. That would more than likely suggest stronger pricing power and the product mix skewed towards the higher ended chips. Now, under that 75% might indicate pricing pressure, so people not having the money, right, necessarily, or they're discounting product, or cost is increasing from supply chain. So it costs Nvidia more money to acquire raw materials to produce the parts, essentially. So that number, essentially 75. Use 75%, super easy. Over 75 on margins, bullish. Under, bearish, which again isn't bad, but it's just not good enough. Be mindful of that. Number 3 out of 10 is your inventory levels. So this is going to reflect your demand, your supply and demand balance, essentially. Obviously, if you have too much inventory, you could be overproducing, and it can also indicate that people aren't buying. So your bullish signal here, you want to see inventory trending lower. Now, take this with a grain of salt, because theoretically, it could also be a bearish sign that inventory is trending lower if demand is all the way up. Two reasons. One, if they can't acquire goods to meet demand, that's very bullish because so many people want their product, but at the same time, you could have 1 million orders, it doesn't matter if you can't fill them. So depending on how that information is delineated on the call, this could be seen bullish or bearishly. It really depends. But overall, I would lean towards inventory trending lower year over year or quarter over quarter. Would suggest strong sell through and supply chain efficiency overall. So they're actually getting the parts they need. They're producing everything. They're meeting orders. They're good. And they're keeping inventory levels at a manageable area. If we see inventory levels rise, it could hint at demand starting to wane, which could lead to future write-downs, discounting products, etc. So again, this one's a little bit of a gray area because there is an argument either which way with how inventory actually moves. So for that matter, you're going to want to at least give some levity here with depending on how the information is. I would really say what they say on the call, because you could see inventory trending lower, but again, if demand is so high and they just can't acquire the products, that's a good thing, but it doesn't mean anything because they can't produce the products, sell the products, to make more money. So that one's a hard one, but it doesn't mean it's not important. So very important regardless. If they say, hey, inventory is trending lower and our sales are up and we're managing everything really well, fantastic. That would be what you would look for specifically in the bull case. Point number 4 is going to be your guidance for Q2. Obviously, the market's forward-looking. Guidance is extremely important. Sometimes guidance is way more important than results, because it's not about what have you done for me today. It's what are you going to do for me tomorrow, right? And especially with a company that's very growth-driven in the sense of this is the bastion of the future, right? We're all looking towards AI as the next big thing. This is a very important part of their earnings because it's going to give you an idea of how strong they are, how strong they could be into the future. So specifically for your bullish signal, you're going to want to look for an above consensus guidance. So right now consensus is like 26, 27 billion for Q2. So you want anything above that, it's more than likely going to be a bullish reaction. That's going to show that management has confidence essentially in demand in general, but in AI as well. So in obviously this big next bastion of growth for the company, seeing that guidance go up above that like 26, 27 area, more than likely is going to show a lot of confidence in their business and that they will achieve continued, and that's the key word there, continued growth for them. Now, bearishly, something to watch out for is they give you conservative or flatter guidance. So I guess in this case, you can use 26 billion. Above 26 billion, bullish. Below 26 billion, bearish. Bearish. Again, growth is still growth, but again, it's not, is it good enough? So, if we see below 26 billion, it could show one of two things. Could show that growth is starting to plateau. So there's not much more demand. Not that it's bad, but growth is just flattening out. Or there could be near-term headwinds. Again, supply chain issues, especially with like tariffs and trade wars and whatnot. That could be some level of an impact here. Point number 5 is going to be their capital expenditures and their R&D spend. So CapEx signal will typically give you confidence in long-term growth in companies, but especially for Nvidia, you want to be mindful of their CapEx because it could show you their ability to build out supply and demand and their ability to sink more money essentially into R&D and innovation as a whole. If you're not growing, you're dying, right? If you don't have the ability to sink more money into the next thing that you're going to do, the next big chip, the next whatever, then your competition can catch up and you lose your footing. So seeing CapEx strength will be very good. Now for this particular thing, I'm looking as the bull side of things for the R&D and CapEx to ramp up, especially if R&D starts to go towards like 1.5 to 2 billion. Would actually not be a bad thing, at least in my opinion, because it could show that they're starting to invest more money into the next gen Blackwell chips or other new verticals, other areas where they can make more money. So seeing that ramp a little bit may not be a bad thing at all. Now, the thing you want to be conscientious of, because this could signal them being more defensive or more conservative would be the word, flat or declining spend. So if you see flat or declining spend, they're less excited about the future. And again, this is all theoretically. Or they're being more conservative on future bets on tech, at least at this point in time. So seeing that come down or flatten out could be a risk factor. So be very mindful of that. Point number 6, supply constraints or commentary on the founding partners, TSMC. NVIDIA depends heavily on TSMC's capacity for cutting edge node production. So specifically with this relationship, you want to see that there's a clear runway essentially for TSMC capacity, that Nvidia can fill these large orders without any delays. It means nothing if Nvidia can't have, again, all their supplies, everything to do their job. Now, if there's the bear side of this, and this would be more like on the call, so if things are said on the call, supply bottlenecks could limit that short-term upside. So even if, and this we already discussed this, but even if demand is really good, if there's an issue with getting supplies, it doesn't matter. You could have all these orders, but if you're unable to fill the orders because of X, Y, or Z, you can't get the certain part from over here, you can't get the certain, we for some reason can't get these nodes, or we can't get these, we can't get enough cobalt, whatever, raw material, other material from another company, whatever it may be, that could be a hindrance on this earnings report. So you want to be very mindful of that. Now, specifically moving to point 7, we want to look at the gaming segment and if it's going to recover or not. So you've seen with the gaming segment, it's kind of declining. Not that it's bad, but because AI is so big, it's just not as big of a focus, I guess I should say. So while AI is very attractive and hot right now, gaming is Nvidia's, it's their baby. It's like their cash cow. It's always been there, so to speak, and that's where a lot of their brand loyalty comes from. My computer is running on an Nvidia card, right? Like this is like that's their old-fashioned bread and butter. It's the thing that's sticking around, and that's what's really good. That's their cash cow would be the best way to say it. That's the most important thing from a simplicity standpoint, I guess I should say. So on the bullish side of things, you want to look for gaming growth year over year, specifically with the RTX 40 cards. Keep an eye on that. That would show that the consumer is being resilient and people are looking to upgrade. So people want the newest card. I will say, as someone who games and as someone who uses a computer, obviously, there isn't, at least in my opinion, a need for a lot of these higher end cards. We're getting to the point where the cards produced by Nvidia are phenomenal. However, the software being produced to run on said cards doesn't need that much firepower. We're not at the point where we're seeing, like, and you could probably argue this if you disagree till you're blue in the face with me, but with a lot of the games that are out there, unless we're playing GTA 6, which isn't out yet, you probably don't have that like super hyper realism that needs this demand of like these newer cards, because there's nothing that can utilize that information, can utilize that the power yet. I mean, think of it this way, for those of you that have seen like the GTA 6 trailers, it's beautiful. Like there's so much detail and so much that's gone into it. And that's going to run on a PS5, which has cards in it from 5 years ago, and it's going to run that. So when you're thinking, and I'm trying to give you guys something to think about here, when you're looking at this gaming sector specifically, the only reason, in my opinion, that you'd buy one of these higher-end RTX cards, or the newer ones, for example, in general, would be to run a higher-end game. But would I need that if my PS5 can run GTA 6, which is going to be the greatest looking game ever at this point? So do I need all this extra firepower? And I think the consumer's smart enough. I think the only reason you get these higher end cards is if you're doing crypto mining, or you're doing something else where you run a heavy GPU load or CPU GPU load on your computer as a whole, where you need that. You're running 1,000 programs, you have multiple monitors, and I don't think that is the large amount of their consumer base. I think a large amount of their consumer base, like I just said, is their gaming segment. It's for games, obviously, and I don't think the demand is there. And this is my personal opinion on this. So that's the bullish thing you want to look for, is that there is demand. There's growing year-over-year growth, especially with the RTX 40 series cards, because that will show that the consumer base is resilient. I'm just giving you my 2 cents in there as well. But the bearish sign is the continued decline, or we're seeing competition steal some of that, like AMD, or, which this is what I just went off of here, lack of compelling titles. There's not games that would justify the need of these higher end cards, at least in my opinion. So for this specific point, I think we'll be bearish no matter what. I don't think Everything else could be like, we'll wait and see. I think gaming's going to remain bearish because it's just not necessary. There's nothing, and someone can correct me in the chat if I'm wrong, but there's nothing that's out there right now that needs this power that is a game specifically. And if we're looking at gaming, that is their bigger customer base. Obviously, like, you could have multiple screens and other things that you would need a stronger card, but if you're just a gamer, you don't need these higher end cards yet. Point 8 is automotive and the edge with AI growth. So Nvidia, this is where you could see a lot of random, I want to say random growth, but you could see a lot of I guess you call it like the moonshot, right? There could be some hidden upside here from AVs, robotics, and edge computing. Obviously, they have some level of exposure here. So for this, you're going to want to look for 50% year-over-year growth in this general area, or any new partnerships with any companies. Obviously, I say obviously, like, there's always news about Nvidia investing in these smaller companies to work on relationships with how to build new chips or whatnot. So keep an eye on seeing if there are any new partnerships that are announced that could show them moving in an area where they could expose themselves to new revenue in a segment where they're not necessarily exposed to, again, like automotive or anything like that. And in this case, in the event that this area flatlines, there's not much news here, or there's not much growth here, the scary part of that for you guys looking at their earnings is it could be that it could signal that Nvidia is like a one-trick pony. They are just the AI data center company. And I don't think that'll be the case. I think, if I'm giving my opinion again, this would be more the bull side, where they're smart enough where they're looking to grow and they're looking to expand outward in general. But it's to be seen. 9, so 2 more points here, is going to be buybacks and shareholder return. Nvidia is sitting on a huge pile of cash. They've still been sitting on cash. They've got roughly, I think, 20 billion. They could buy back stock. With that being said, it's near its highest evaluation. It has come down, obviously, from the high, but you could see a buyback. Obviously, that would be bullish for the stock in general. And an aggressive buyback would signal that they have confidence, obviously, in their stock, and that they believe that it's undervalued and growth is still intact. So it's going to increase in value, so to speak. But if they continue to hoard cash, just in general, so we're not seeing R&D go up, and we talked about this earlier, we're not seeing additional partnerships where they could do something with this money. If they're just hoarding the cash, that could be another conservative take where they're looking to be a little bit more defensive. So it's not necessarily like it's a bearish thing, but that could signal bearishly, because if they're hoarding their cash or they're not looking to do buybacks, the market may start to question how efficient they are, and if they are moving to a defensive posture as opposed to an offensive posture, which, as the bastion of growth, the big thing right now, they need to be offensive, because that is what they're priced at. Their evaluation right now is because the market sees them as offensive, and they need to hold that segment. They need to hold that I want to say namesake, that offensive structure, if the market is to hold this evaluation, meaning holding its current price. Lastly, you're going to want to pay attention to any commentary on the competitive landscape as a whole. So obviously, Nvidia is not the only chip maker. You got AMD, Intel, and other companies like Qualcomm, whatever. And also, other companies like Amazon, Google, and Meta are now designing custom AI chips. This could eat into their market share in general. Now, the CEO has downplayed the threat and basically said that because of Nvidia's position, they're basically a full stack moat with their hardware, their CUDA, plus their software. So it is a big, for those of you who don't know what a moat is the ability to enter the same market. So if someone wants to compete with Nvidia, there's a lot for them to do to get to that point where they're actually competition. So that's when there's a high moat, that's what you'd have to go through. If there's a low moat, it's very easy. So the CEO is arguing that there's a high moat, so consequently, yes, there could be competition, but they'd have to jump through a lot of hurdles to get to where Nvidia is right now. Now, bearishly, so that's their bullish thing, is that the CEO has confidence right now. In general, this is just something to be aware of if they say anything that could hint bearishly on commentary on the landscape in general. So any acknowledgement on the call of market share loss or risk from custom AI chips could change long-term growth expectations. So this wouldn't necessarily be something to be concerned of like on the front end, like right here, right now. it could scare a few people, but looking at your long-term projections, if there is acknowledgement of that, or if anything like that is said near term, that's enough that could spook the market even near term, where some people are like, oh, I don't like this, and if I think as an investor that Nvidia could be overvaluated here, and also there are additional threats to the market, then I may want to get out. So that was your 10 things to look out for on Nvidia's earning calls today. So hopefully you guys enjoyed this, and yeah, see you next time.